Hello, everybody, and thank you for joining us today. We've got a full panel of knowledgeable individuals joining us. So we've got Deep from our partners at TMFD, the accounting team that we work very closely with. We also have our team members here. Pear is here. Hello, Pear.
Hey guys, thanks everybody for joining so far.
And we also have Leah, part of our marketing team. So a lot of you might have seen or spoken with Leah before. So thanks, Leah, for helping put this all together. And very excited today to have Deep talk about year-end tax planning and the recent budget that's come out. So today we're going to tease out any changes for you, for personal side taxes, business side of taxes, what that means for us, if anything. Is there anything that we should be mindful of or changing? So we're going to look at that. And also a great time at the end of the year to review our top year-end tax planning tips and just make sure we clean everything up or review anything before year end. So that's our agenda for today. I will pause here for station identification and sharing of the disclaimers. And perfect. I think we're good on that front. Okay, great. So I wanted to, welcome everybody again as we let everybody settle in. This is our team, myself, Pear, Jeff, Leah, Joan, and Kashfi. So most of you might have likely spoken to a few of us before, but always nice to have a few friendly faces up on screen. So that's our team today. That's who supports you here as part of WWH, and we're very happy to do so. And today's guest speaker, Deep, thank you so much for sharing this time with us. Deep wealth of knowledge on the tax and planning side of things, done both on the personal and the corporate side. So, Deep, very excited to have you today, and thank you for sharing your insights with us.
No problem. Hey, everyone.
Yeah, thanks, Deep, for joining. Deep's a little bit under the weather, so he's powering through from as you can see, the AI virtual office. But it doesn't change his knowledge and his and everything. So we appreciate you joining, Deep, even though you're probably on death's doorknob, I guess.
Yeah, no
So
problem. Hopefully the knowledge stays the same even after the flu.
there you go.
No,
We'll keep you in mind if not. And just one last note, a housekeeping team, if you do have any questions or you would like to ask myself, Deep, prepare something, please use the chat or the question function below, and we will make this as interactive as possible. So we encourage that. Please use that. And without further ado, Deep, off to you, good sir.
hey guys. So we'll start off with the tax changes brought up by the federal budget. Leah, if you want to go to the slide. Uh, okay. Luckily for accountants, there weren't that many tax changes in 2025. As accountants, we hate change. Any changes brought up is just usually more extra work for us. But there are some significant changes made this year. So we'll go over some of the big ones. Firstly, they removed the 1% tax on vacant properties. This was originally introduced in 2022. The UST applied to certain owners of vacant and underused resident properties in Canada. This was a 1% annual tax on the property's value, so it could be hefty at points. The 2025 budget basically eliminates that, and as of the 2025 calendar year. So there would be no UST payable or no UST returns would be required for 2025 and subsequent calendar years, which is good. And all of the UST requirements still apply for 2022 to 2024. So that was one of the big ones. They also removed the luxury tax on vessels and aircrafts. As you know, the federal government imposes tax on vehicles and aircrafts with a value above 100,000 and vessels such as boats with a value above 250,000. This tax ends after 2025 budget day, which is I think was November 4th, 2025. Unfortunately, the budget does not only mentions actually vessels and aircraft, so there is still tax on vehicles. So if you're planning to buy a nice sports car for the summer and you're still in on luck, lucky are the ones who can afford a boat for over 250,000, unfortunately. Um, The third one is accelerated CCA on manufacturing assets. So this one is business. This one is for businesses only. If you have a business which has manufacturing equipment, you can get an additional deduction. And if you're planning to buy a manufacturing equipment, you could get 100% write-off of that equipment in the first year. So this could lead to huge tax savings in your first year, or for either your corporation or even in your personal taxes if you have the business under your personal name. The fourth big one was the personal support workers tax credit. So this is a temporary credit for PSWs. Provides 5% credit of earnings to a max of about $1,100. There is some criteria to be met, but we won't get into that. But if you have any questions regarding that, let us know, and we can reach out back to you. So these were the four big ones that are kind of impacting most of the population. You can jump on to the next slide, Leah. So on to some personal tax tips for 2025. These can help you save some taxes. First one, big one is maximize your RSP contribution. So RSPs are a direct deduction of your income and the best way to lower your taxes. Tax savings depend on your tax bracket. So you could potentially save up to 53% in taxes if you're in the highest tax bracket. So, depending on what your tax bracket is, it's going to chip off of your income off the top line. So it's whatever. If you're jumping into a higher tax bracket this year in 2025, you may want to look into contributing towards RSPs. So it's going to help you save some big bucks there. The second one is realizing your capital losses. This one is beneficial if you had some capital gains in 2025, if you had either sold a property or sold some stocks or sold a bit of your portfolio, and you have some capital gains that you're going to be taxed on in 2025. One way to offset those taxes is to sell any stocks which are currently in a loss position. So what happens is, you got the capital gain on one side, which you're going to be taxed on. The other side, if you have some losses that, you haven't used up, no, you can sell those, and those can be applied against those capital gains. And this will help you kind of reduce your taxable capital gain, and thus your taxes on your capital gains.
And Deep, on that side, can you also talk about how the carry back and carry forward rules apply on the capital losses, just as of
Yes. So if you had some capital gains, let's say in the past 3 years, and you had paid some taxes on those, you can potentially get those recover those taxes if you have a capital gain loss in 2025, which can be carried back, carried back for 3 years and carried forward about 10 years. So what happens is, let's say you sold a property or had sold a portfolio in the past 3 years, you paid quite a bit of tax in those years, and now you seem to be accruing a lot of loss on certain properties or certain stocks, and that you feel that are not going to go up in value or may not be a good investment. Talk to a pair, talk to Erik, and see if it's beneficial for you to potentially sell that and realize those losses, because those losses can also be applied to prior years and recover those taxes. And so that could be a benefit to you. Plus, if you sold stocks this year and there were realized losses, you don't have any gains, your losses will be carried forwarded. So if you have gains in the future, they can be applied to reduce those future taxes.
Yeah, good point on that, Deep.
Yeah, and third one is making charitable donations. This is if you're thinking about it, then the time is now. Do it before December 31st. Obviously, it's for a great cause, but they help you save on taxes too, so it's a win-win situation. But CRA did extend that date till February also. So if if you haven't made up your mind and you donate in January or February, you can also use those donations against your 2025 taxes. The main thing is they have to be in cash. those cannot be, stock and portfolio donations. We'll talk about that in a later slide. But the ones that are, that you can are doing in January and February, those can only be in cash, and but those can be applied against your 2025 taxes. But the best way, make sure you get it out of the way, is just to do it before December 31st, if you're already thinking about it. Yeah, and fourth one is just make sure check for other deductions, such as medical, tuition if your kids are in university, home office deduction. If you're working from home, the home office deduction is big if you're for businesses and employees. Uh, for businesses, you don't need to only thing you need to document is the space that you use in the home, and all the expenses. For if you're an employee, it's a little bit more complicated. You have to get a form signed from your employer called a T-2200. So which kind of designates which expenses you can claim. But if you're working from home, if you have a business, you can claim it. And if you are an employee, please talk to your employer, get that form signed so you can claim that deduction.
Just on that note, very useful for in your perspective, seeing as you see a lot of these numbers come through. Any red
Yep.
flags to avoid on the deduction side of things? I mean, any guidelines that can help people as they look to claim? So maybe we're not pushing the envelope too heavy. Any guidelines that you like to share with clients in
Just check your medical first. Not everything can be claimed under medical. Reach out to us if you're not sure. People like to get voluntary checkups every year, which could be quite expensive. Just make sure that you can deduct those. Check with the company that you're doing those with. Um, you know. Tuition for kids. Some people forget that if you even if your kids are studying outside Canada, they just need a additional T11A form signed. Those tuition credits can still be claimed. So just make sure if you're not sure, reach out to us for that. And but yeah, universities outside Canada can also be those tuition credit can also be claimed. For home office and business expenses, people forget, you use your cell phone. That can also be claimed. Yeah, there are some expenses that cannot be claimed if you're just an employee, such as your deduction on your property tax and your mortgage interest. That can only be claimed if you're using your office for a business, not for employee. Does that cover everything, Eric? Everything you want?
Yeah, good stuff. I mean, something that comes up often, and just want to make sure people are writing off more. I mean, you want to get as close as you can, but you don't want to set off any flags and alarm bells. So good
Exactly.
information.
For the property tax, Deep, I know for businesses we want to be careful with that, but also for seniors and students and lower income individuals, claiming your property taxes also leads to some grants from or some benefits from Ontario, like a
Yes,
trillion
yeah.
benefit
So
or something like that, right?
yeah, so the property tax is I only mention it for if claiming is a home office deduction.
Yeah,
But if you are a low income individual, you can claim a property tax credit as on your personal taxes, and they help you recover some trillion benefits. So always provide your property tax receipt if you feel like you're making lower income, close to, I think your combined family income has to be lower than 40,000 to claim that
yeah,
part. And so if you're under that, yes, please send in your property tax receipt, because that's a
yeah.
separate.
That's often useful
Yeah,
for seniors and students, and also
exactly.
if you're paying rent,
Yes,
there's a property tax component to your rent as well. So make sure that you give Deep or the TMFD team or us details on, and if you're paying rent, how much rent you're paying, because we can try and see if we can't recoup
exactly.
some of that for you as well.
Yeah. The rent
In
has to
terms,
be paid in Ontario, though.
that's right, in Ontario,
Yeah,
and because it's in Ontario, same with the property tax, it's an Ontario grant, so it has
it's
to be
in
in
Ontario.
Ontario. In terms of medical expenses, what about for seniors that are now living in, an Amica or maybe a kind of a retirement home or an assisted living facility? There's some ability for them to claim taxes as well, or claim
Yes.
deductions there as well, right?
Yeah, so there could be a big medical expense that could be claimed if you're, especially if you're if you have some sort of disability as a senior, if you're working in an assisted facility in a retired home, there is a portion of that expense that can be claimed. So make sure you give us the full receipt, and if you're disabled, we can usually check online if you have already claimed the disability tax credit in the past. But if you have not, this is your first year, make sure you apply it. It's a form that you need to get your doctor to sign, and they send it into CRA, saying that you're eligible for the disability tax credit. So, one way is to get the disability tax credit. Other way is to claim the medical expenses. And, we usually try to see which one is higher,
Yeah.
and see which can be claimed, and then we go from there.
And the interesting thing I found about the disability tax credit is if, make sure your doctor says on the form when the disability actually started. So don't just start from this year. Because I
Yes.
found the CRA is pretty good about this. If I say it, the disability actually started 10 years ago, I just haven't done anything about it. When the doctor sends
Yes.
in the form to the CRA will then go back and revise all your previous returns as if you had the disability tax credit, and you'll get some nice refunds typically.
Exactly. Exactly.
Yeah.
That is important if you have missed out on this credit in the past, and if you feel that you have some sort of disability, which you're not able to support yourself, or you can't go to work, or you need someone's help, especially if you live in an assisted care facility, and this disability might have started in the past, and you feel like you made a missed out on it. You can still go back and recover those taxes. So, which is big, and there's not a lot of work required. All the doctor has to say is, let's say, just say this disability started in 2015, and then CRA will actually go back and automatically amend all your taxes, which is good, because
Yeah.
then you don't have to come back to us, pay us additional money to file those taxes, which could be a lot of money if you're filing for 10 years. And so, you just basically CRA is giving that credit off to you for all those years without any charge, which is good, which is a great benefit.
One of the few examples of the CRA being efficient. So that's good.
Yes,
Yeah.
very one of the very few examples.
Yeah. Yeah.
All right.
Thanks, Steve.
We'll jump on to the next slide, Leah. So, yeah, so again, we discussed, contributing towards your RSP. So we want to make sure we're kind of optimizing the RSP contribution. There are a few ways of doing that. The first one is the earlier contribution benefit. If you know you're going to contribute, then I would suggest to contribute early. So, if you're in a certain tax bracket, you've already discussed with Erik and Pierre that the best way to save taxes is to contribute. Don't wait until the year end. Don't wait until the final date to contribute, because if you contribute early during the year, or you're doing it on a monthly plan, all that money is already growing, right? So if you're waiting till next February to contribute, that money sitting in your bank is not earning you anything. If you know you're going to contribute early. And the second point is, check your unused contribution room. Always check if you have room available for past years that you have not used. The best way to check is your notice assessment or your CRA account. Ask Erik if they have access to your CRA account. And the past room still could be used to reduce your 25 taxes, especially if you're in a high income tax bracket. So always check any room that you have not used in the past. Third one is, spousal RSP income splitting. If you have a low earning if you have a low earning spouse who cannot contribute as much, consider spousal RSPs. You use your room to contribute, and plus you get the deduction, but when withdrawn in the future, the income will go to your spouse. So, you might be, maximizing your contribution room, and you know that you're going to have all this income in your retirement, and your spouse is not. So, at that time, that income, when you're withdrawing, is going to go towards all towards you. But if you are, if you have a spouse that's not contributing, and you contribute towards their plan, it will allow your spouse to kind of withdraw that money into your, and they're going to be taxed on it. So you're basically sort of reducing your taxes, when you're going to be withdrawing this money, likely towards towards your retirement. So your income splitting for the future. Fourth
And Deep,
one
just
is sorry, you had
I just
something?
want a note on that because I mean RSP or RIF withdrawals, you can start splitting at 65.
Yeah.
So just interested in your take on when it makes sense to use the spousal plan, or how you've seen that in practice from the accounting perspective with the income splitting that you can do at 65 and the spousal RSP.
Yeah, so some people retire early, in their 60s, not don't want to, work into their 60s. So if you're planning on retiring early, the best way is using the spousal plan. And if you're not going to be, especially if you're going to be having some sort of other pension income, and your spouse is not going to have any other income, your spouse can start withdrawing early out of their spousal plan, and likely they're not going to have any other income. They're going to be taxed at the lowest tax bracket. So that's the best way.
Yeah.
The fourth one is just coordinating with your employer plans, right? So if you have an employer matching plan, take advantage of that. If your employer says they can match whatever amount, I think that's just the best way to contribute. The only thing I would say is be careful of over contributing, just because if you're you have if you're contributing with your employer, you may not be maxing out, and then you might be contributing. You might have an RSP plan somewhere else too. Just make sure that both those plans on a combined basis don't go over your limit. That's the only thing you have to be careful about.
Yeah, and I've often seen that with sometimes bonus payments. If you're auto signed up for a percentage match, you can have a large lump sum go in at any time, and that might throw everything off. So if you have an outside plan, just a good reminder, just check what's going in and make sure we're not going over, because
Yeah.
to Deep's point, then you've got to deal with the CRA, and that's always a waiting game and costs time and money. So
A
Exactly.
really good
Right. So,
point. And just talk to us or talk to TMFD, and we'll help you with that.
yeah.
But like Erik and I always say, we really like the employer matching plans. We always like to get as much free money as possible.
Yeah.
So, get the free money from your employer matching man, RESP grants, everything. So always about the free money, right? So that's key. It's the number one way to give yourself a raise. And then we can always talk later about, maybe you don't like the way the group plan is invested. We can always work with that and move the funds over after the fact to Asante if that's what you want.
correct.
Yes. You want to jump onto the next slide, Leo? So some donation and some year-end strategies that we can discuss. We talked about donating before. I would say the best way to donate is through your investment portfolio or your stocks. If you have highly appreciated stocks, you can donate those. This way, you actually save on the capital gains and get the full deduction for the fair market value of the stock or fund. It's sort of double tax savings. So if you have a stock that is valued at 10,000, and it initially cost you 5,000 to purchase, and you're thinking of donating $10,000 this year in cash, I would say donate that $10,000 stock instead, because what happens is the 5,000 capital gain you have, you don't get taxed on that. And so that's one way to that's tax saving on the capital gain already. And then you also get a receipt for 10,000 for donation. So you actually are getting credit for 10,000 of the money that you're doing. So you save on the capital gains, plus you get the donation tax credit of the full receipt of the amount. So it's sort of double tax savings there, which is good. The second one is
Quick question on that. How long? So let's say I have that stock and I'm in the pleasant position of having it appreciated, and I
yeah.
don't donate $10,000 of that stock. I get to skip out on the capital gains. Do I have to wait before buying that stock again in my portfolio? Because if I have
Yes.
$10,000 stock and $10,000 cash, I'd rather give the appreciated stock and then invest the $10,000 cash. I end up net with the same portfolio, but I
Yes.
now reduced my capital gains liability, which is really good. So do I have to wait to buy it again?
So that usually those rules usually rules apply to losses, but I will double check on that for you, Pair.
Yeah.
I don't think
Okay.
they applied in this situation. I
Great.
think you are able to purchase the stock right away, but I'll double check and let you know on that 100%.
Yeah, that sounds what I thought as well. Yeah.
Yeah,
Great.
yeah. I don't think those rules usually apply to, if you're trying to create a capital gain loss and then buy that stock again. Those stop loss rules apply in that situation, so you won't be able to claim the loss. But I don't think those rules apply where you're kind of realizing a capital gain and then you're able to buy that fund again. I think that strategy is still okay, but I'll double check and I'll let you know.
Very helpful. Thanks.
Yeah,
And then
and
Deep, just on the credit side, so you say, I mean, say you donate 10,000, how does that work from a pure tax perspective? I mean, is that $10,000 that the client can now write off, or do they get an appropriate percentage of that and abate in taxes? Because often clients confuse what that looks like from a tax.
No, donations are not actually a deduction.
Right.
So it depends on how much you donate. So I think the first $200 is about 15%, and then anything over $200 you donate, it's about 30% tax credit. So tax credits and deductions are not the same. Deductions reduce your income and affect tax you're going to go based on that income. Credits are something different. Credits are, they have a set amount of tax that it's going to reduce, and it doesn't matter how much income you have. But the donations do have a higher tax credit. Most tax credits only give you 15% in tax savings. But donations, anything over $200 can reach up to 30% in tax savings. So which is better than most other tax credits.
Yeah. So in this example, say we did 10,000, so 30%, assuming above that
About
200.
close to $3,000 you'll save in taxes.
Yeah. So that's
Yeah.
meaningful. Very
Yeah,
nice.
it's quite meaningful. To give you an example, compare that to tuition credit, which is kind of a standard credit. On that $10,000 of tuition credit, you only save around about $1,500.
Right.
So yeah, it's great. The government incentivizes you to donate,
Yes.
which is good.
Very good.
The second one is, I guess, the donor advised funds flexibility. Per and Erik are probably more knowledgeable on this one, and they can help you if you ever need to. So these are funds that you kind of donate to, but you get the deduction right away. So let's say the year end is coming up, and you don't know which charity you want to donate to, but you still want to donate and get the tax credit before the year end. So that's why they have these funds, so you can transfer your investments to a certain fund, and you get the deduction right away. But then, or the money that is sitting in that fund, you can decide where that money is going to go to. I think I'm not 100. Correct me if I'm wrong, Gary. Then you can choose which charity this goes to,
Yeah.
and yeah. So which is great. So if you're kind of nearing the year end and you're stuck and you don't know where you want to donate, you can donate to these funds and decide later. So they provide you pretty good flexibility.
And I'll just touch on that because it's something that, at least for a few clients, we've started opening up this year now that these have become more and more prevalent. And just to add some color to that, so essentially, you normally will look two things. One, a non-registered account with significant gains. So as Deep was mentioning, either a stock or a fund or something that's appreciated tremendously in value, that if you simply sold, you owe the capital gain on. So criteria is number one, do you have a large non-registered account with holdings in a significant gain position? And two, are you doing donations anyways? And is that something that you would like to do? So if those two are true, then generally looking at a donor advised funds might make sense. Now there are minimums, generally 25,000. So I normally say 50,000 to fund it is likely the minimum amount that would make sense. And then the way it works, to Deep's perspective, is you could donate a security or fund in kind. So say you take 50, or let's use the 100,000, you move $100,000 in kind, that capital gain vanishes, goes away. So you don't have to pay any of that. 100,000 shows up in what's called a donor advised fund, basically a new account that would show up on your statement. And once it's in there, you have to donate a minimum, I believe, is 5% annually. And that 100,000 can be invested. So technically, this foundation that you set up can grow and basically fund itself in perpetuity. The nice thing is you get that donation credit right away. So in this tax year, you get to write off the full amount, and then you only have to donate up to 5% of the fund. So it pushes the decision on to later. So really nice piece. If that's something you're interested in, please reach out. But we've set up a few of these, and they're very well received. So end of
Yeah.
parent.
And what I like about them too is it creates the ability then to sit down with the next generation, with your kids and your grandkids, and say, listen, we've put aside this much money for charity each year, and what are the causes that are important for you, and have that discussion as a family. So who do you want to support, and not feel rushed like, oh geez, I need this tax deduction for my Deep says I need that 30% write off, and then quickly pick a charity and then have remorse later. So it creates an ability to do that. It's great, really great.
Yeah. Far more purposeful, and to Pierre's point, invites those conversations between generations, which is wonderful. So really neat.
Yep. So, on the final note, there's some other year-end strategies that can include, such as TFSA, where your money grows tax-free, even though you don't get a deduction. But maximize your TFSA is always a great strategy because the money inside that TFSA is tax-free. Whenever you pull it out, it's not going to be included in your income. So always try to maximize out TFSA if you can. Portfolio rebalancing. This is purposely accruing, capital gains or losses. Again, the best people to discuss, if you ever want to consider that, is to get help from Erik and Pierre if this is the right way for you. Overall, just kind of stay organized and make sure you document all the expenses for yourself. On the final note, I think we will be sending out a personal tax checklist in February, just before the tax season. We don't send it out in 2025. Just people seem to forget about it, so we just like to give a reminder just before the tax season in February. The tax filing starts usually mid-February, around February 20th. We usually don't like to file taxes until March, since the tax slip deadline is February 28th and the RSP deadline is March 1st. And most companies sometimes wait until sometimes even the investment companies wait until February 28th to issue certain tax slips. So we usually like to send the file the taxes starting of March, but you can still try to get everything organized in February. If you're waiting on a slip, make you and you're sending in your document, make sure you let us know that you're still waiting on certain slips from CRA. Best way is to compile everything together, make sure you have everything, mark off everything we send on the checklist, and send the documents all together to us in one order, and basically in one document. And that makes it easier for us to kind of organize everything and get back to you as soon as possible. And opening it up for questions.
Good stuff, Deep.
Thank you.
So we'll pause for a question. Well, one that came to mind with the new budget. I mean, anything that clients or anybody needs to be prepared of. I mean, our take on it. There's not much that changes on the day to day, other than the capital gains, removing that increase.
There was not actually not many tax changes again this year, right? If you had UHT in the past, if you had pay tax on that again, you won't need to file and pay taxes on that. Rest of the stuff, it accelerated CSA, it's covered under your corporate and your business taxes. Tax on cars, that's going to be taken care of by your dealership. You don't have to worry about that. And personal support workers credit, it's not much, only $1,100. And just let us know if you are a personal support worker, and we'll claim that for you. Yeah, not many changes this year.
No, agreed.
Unlike last year, which was a hefty year.
Yes, which is probably welcomed in this year, because I know it was rushed last year to implement the changes. So nice to be able to be a little more proactive and not being so reactive in this year. So
exactly,
I'll take that. Pierre, any final questions or thoughts for our?
Well, just a thought. We like to work with Deep and Steve and the TMFD team to help our clients with their tax filing and compliance. Your first point of contact will be our team. So myself, Erik, Leah, Joan, Kashfi. You'll start as clients of Asante, you'll start getting, or of the WWH Financial Group at Asante, you'll start getting reminders in the new year to get your papers in order, and then we'll let you know how to submit them. Either you can come by and drop them off, or we have an online portal where you can upload them securely. We then collate everything and we share it all with Deep and his team, and they do their magic. If there's something, and then they send us back the returns, we review it, and then we send it off to you to sign. So it's all pretty smooth and seamless from your perspective. If you do have a complicated situation where you've got a rental property and you want to talk about it, or you think about selling it, or maybe you're buying a business, those kind of things, that's where Erik and I can help you with the tax planning on that. And where needed, we'll pull in Deep and Steve and the team to sit down with you and provide that extra level of expertise. And they're very happy to do that. So we're here to help you on the tax planning and tax compliance side. And hopefully you guys find this webinar useful as well. Gives you a few tips.
Deep, one thing that does come up is, say somebody passed during the tax year, what should they be preparing, or what should they know about filing taxes in that case?
So we have a whole separate checklist for that. I can send that out to you, Erik, if there's a certain situation that's arrived, and you can send it out to them. It gets a little bit more complicated because they have to file the final tax return in 2025. Plus, there might be another trust return that may be required depending on if all the assets, were distributed to the beneficiary during the year or not. So, and then there's a separate checklist for that too. So it gets a little bit complicated, but I'm happy to share any checklists that you may need for that time. At that time, there's a bit of more tax liability, possibly, just because your investments that are in a non-registered plan are considered to be sold as of that date. So, and I'm happy to share any checklists with you.
Sounds good. So I guess the reminder for clients on if that's the case, sooner rather than later, reach out, and that way we can help get you.
The only urgent thing I would say is just call into CRA to advise on the person that has passed.
Good point.
Yeah.
And that is to stop CPP, OAS, and all of
Stop CPP, OAS, any GST,
Right.
that benefits or trilling benefits that they may receive after, because the government doesn't want to pay you after you passed away. And if they have paid you, they're likely going to recover that money. So if you advise them, let's say a week or two after, likely nothing has been paid, and they'll know, and then they'll stop those things.
Good tip. Good recommendation.
Awesome.
Beautiful.
Well, Deep, I hope you feel better soon. Good news is that you're sick now and not during tax season, so that's positive. Although during tax season you won't be sick with the flu, you'll be sick of taxes.
Exactly. I'm always sick during tax season.
Yeah. So I think, as you all can tell, Deep happens to know his stuff. So if you have any questions, please feel free to shoot them our way, and if we don't have the answer, we'll definitely get them from Deep and his large brain. And yeah, so thanks everybody for joining. Erik, do you have any closing remarks?
That is it. Just big thank you to everybody for the team for organizing this, and Deep for showing up and sharing everything. So we appreciate the partnership, and we're thankful to have you as part of our extended team. So thank you very much, Deep.
No problems. Thank you, guys. Thanks, everyone.
Thanks, Deep.
Bye.